Hey, good afternoon, everyone, and thanks so much for giving me your time. This is Mark from Right Line Trading, and I'd like to familiarize you with what I believe you're going to find is a really powerful trading system. Now, first, um, the disclaimer, excuse me, that we're obligated to read is that the trading opportunities, both orally, written, or electronically, that are disclosed to subscribers are for educational and demonstration purposes only. Our Right Line Trading takes no responsibility for any participation by visitors or subscribers for any profits or losses that may occur. Careful consideration of your financial positions should be made prior to trading. Never risk more than 2% of your account on any trade. Right Line Trading is not a registered financial advisor and not a licensed commodity trading advisor. We recommend that you consult one before you make any trading. Okay, and with that done, let me just familiarize you with a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. I've published close to 15 peer-reviewed articles in first-tier journals. I've been involved in the financial markets for over 20 years. Now, Right Line Trading is the product of over a decade of analysis of price action, market structure, and indicator algorithms. Now, the software is based on mathematical modeling, and that is my area of expertise. And that is the mathematical modeling of closed systems. In my graduate work, what I did was mathematical modeling for the U.S. Navy. They were, back in the old days, they were doing deep dives, over 1,000 feet. The decompression schedule was very, very dangerous. Divers had to switch gas mixtures. They had to take periodic rests or take pit stops on the way up. And the risk of getting the bends or getting underwater decompression sickness was high. And what they used to do was create the underwater decompression schedules via trial and error. And for the first time, what I did was apply mathematical modeling to decompression schedules and provide the Navy with a much, much better way of bringing up divers from a very, very deep dive. Now, our software is one of the fastest growing trading systems on NinjaTrader. Now, the Unirenko trading system that I'm about to show you, I believe, is going to be something different than you've ever seen before. It's going to give you, and I'm going to spend, and I want you to know, I'm going to spend a lot of time on the slides themselves, not on the slides, but on charts. I want to show you the system. I want to show you the entries. Anyone who gives you a presentation off the slides can pretty much show you whatever they like. I want you to understand how the system works, but then we're going to quickly move to the markets. Now, the software produces very precise signals that really do work. Now, we're used by many, many funded top step traders, and we just got a couple of new ones in the room today. Now, we have 150 people in our live trading room, and the number is rising quickly. Now, the system was created, as I mentioned, via the use of mathematical modeling techniques. These are essentially computer-driven algorithms. I don't want to bog you down in the math, but what we look at is we look at for all the independent variables that are responsible for the future movement of price on any market. And you're going to see that all our indicators are leading indicators. They're not lagging indicators. And that's what you see in most software. They tell you where price has been, but they don't have any ability to tell you where price is going to move out into the future. What our indicators do is predict with a high degree of precision where price is going to move out into the future. And they do it on any financial market and on any time frame. If these are truly independent variables or forces that move price out into the future, the financial instrument, whether it's crude oil or Google or a Forex pair, it doesn't make any difference what the trading instrument is, and it doesn't make any difference what the time frame is. If they really are forces that move price, then they're going to be operative on any financial market and on any time frame. Now, as I said, you can trade it with futures, Forex, and stocks. All the indicators have forward-looking ability, and you're going to see that real clearly. And these indicators lead price. They don't lag price. And the whole purpose of the software is to show you and help you predict where price is going to move out into the future. As I said before, we don't care where price has been, and that's what almost every indicator that you see out there does. It tells you where price has been, but it doesn't tell you where it's going. Now, the markets have changed real considerably in the last couple of years. For many years, I traded tick charts. And this is an example of a tick chart. Now, the reason I like tick is because there's only one independent variable that determines when a new candle is going to be formed. And that is simply the degree of market movement. You create a 10 tick chart. Every time price moves 10 ticks or 10 pips or 10 cents, you're going to get a new candle. It's not dependent on time, and it's not dependent on ticks, as a tick chart would be. Only one variable determines when a new candle is going to be formed. Now, tick charts used to be real good, but the market has changed dramatically. Now, this is the same move you see here on tick charts on a Unarenko chart. Now, Unarenko bars really give you optimal entries. They obliterate some price action, but they really define the trend, and they get you into the best trades, and they keep you in the trades. Now, Unarenko is different from Renko. These aren't bricks. These create wicks, so you do get the ability to define some market structure. So at this point in time, there is no better type of candle to trade, no matter what you're trading, than Unarenko. Now, our Unarenko candles are not standard. First, they're optimized. And secondly, they are coded to not create what's called shadows or ghost candles. Sometimes a Unarenko can create or fill in an area where there's no volume at price. Actually, no contracts or shares or Forex volume is traded, but the candle will simply create an area, a false area. That's been coded out of these candles, and price action and market structure as they create it are exactly perfect. That makes a big difference in how price is represented on your chart. Now let's look at the pluses and minuses of using Unarenko bars. Now, they do obliterate price action to some extent. Now, if you're a big Japanese candlestick pattern fanatic, you're going to lose some of that definition. You cannot evaluate an engulfing candle, a dark cloud cover, a piercing candle, a doji. You're not going to see these these Japanese candlestick patterns on Unarenko. You're also not going to be able to see a rising and falling triangle. You will see channels to some extent, but you're not going to see a bear flag or bull flag patterns. But I'll tell you, in recent years, with the change in the way the market is moving, these what are considered to be classic patterns carry much less throw weight. And all of these guys who are pitching these, I found 3 simple chart patterns that made me $25 trillion, are really just pitching you a phony deal. There's no simple chart patterns that are going to make you successful at all. Because who's in control of the market about 75% of the time, actually 100% of the time? It's the institutional traders. And they skew all of this. And I just want to give you a piece of information that you're never going to hear anyplace else. When the Japanese developed Japanese candlestick patterns, the rice traders 400 years ago, they made a supposition, and the supposition is that the power of every trader was equal. So if trader A wanted to go long and trader B wanted to go short, their supposition was that the power of trader A and the power of trader B was identical. And back then, that was true. Pretty much every trader had the same ability to move any financial instrument the same. They had the same power. This is just completely untrue today. When the institutional traders move in and they start pouring money into the market, they completely dominate. And what our goal is not so much as to read Japanese candlestick patterns, is to get on the side of the institutional buyers as quickly as possible. So I like Japanese candlestick patterns, but they have lost a lot of their power, just as these rising and falling triangles, et cetera, what you're told is that these show you market sentiment. They're telling you what traders are thinking. Are the bulls in control? Are the bears in control? But at the end of the day, it doesn't matter. It only matters what one entity is thinking, and that are the big traders, the institutional traders. Now, the strength of Unorenko bars is they filter out a lot of noise. But in order to trade them, you really do need powerful leading indicators, because usually if you see a lecture looking at Renko or Unorenko, and I have not really seen any other Unorenko lectures, and I watch a lot of other people's webinars. You may have, I have not. They're going to show you a trending market, but what they're not going to show you is a choppy market. And Unorenko bars can really, really hurt you and dent your equity in a choppy market. So you have to have the ability to bypass chop and get into the market when the market is trending. And just don't forget one thing, that your goal as a day trader or swing trader is not to accumulate winners. It is to avoid losers. So every day trader and swing trader usually gets a real significant number of winners. What differentiates or separates the successful traders who trade consistently profitably is they are able to filter out the losers. So that's our job. We're going to get winners. Let's filter out the losers. And that's the key, really, to becoming a professional, profitable day trader or swing trader. Now, I'm going to skip these. And what I want to show you now is our 3-line V2 indicator. It utilizes 3 variables or 3 forces that move price: momentum, stochastic, and order flow. And I'm going to show you how each one works and why each is equal in power, will determine the future movement in price, how we calculate it, and how we put it all together. Now, the first force I'm going to show you is the last line, actually, on the 3-line V2, and that's order flow. And order flow is, the newest. It's kind of a trendy indicator, but I believe very, very few people understand it and know how to leverage it in an appropriate way so that it really provides you with predictive information. Now, I'm sorry for the blurriness here, but you can see this is a green 2,985. And what this is telling you is that there's a predominance of buyers over sellers in market depth on your dome. This is not looking at executed trades. It is simply looking at the number of buyers versus the number of sellers. So it's really looking at market depth. Now, on this up candle, market delta is positive, 29.85, telling you that there was buying pressure in the market because there were more traders looking to buy than there were looking to sell. Now, here's where a lot of people get messed up. And that is, this is also a positive delta, but this is a down candle. Now, this is a positive 222. Now, the magnitude of the number is important, but whether or not it's green or red is most important. And this is telling you, again, that there's buying pressure on the candle based on market depth. So what's going to happen if you do order flow tracking is that from time to time, it's actually more common than from time to time, it's going to mislead you. Now, here's just a series of candles, each with their delta. And you'll see that it's not uncommon for a down candle to have a positive delta and for an up candle to have a negative delta. So if you do order flow tracking, this is really going to create a problem for you. Now, this is simply a curve of the magnitude of the delta. But since the delta can create a down candle on an up number, this rising or falling plot has absolutely no value at all. And that's what most software shows you, simply the plot of the absolute value of the delta. But as I said, a negative delta can give you an up candle. So how do we do order flow tracking in a way that does provide us with predictive power and the ability to see the way the market's going to move out into the future? And here's what we have to do. It turns out that one standard deviation's worth of data is what we're looking for. And the outliers are what we want to eliminate. So if you remember, I don't have a picture of that bell-shaped curve. We want that 67 2/3% of delta information, and we want to kick out the outliers, because the outliers are the negative delta on an up candle or the positive delta on a down candle. And that's not such an easy thing to do, but I'll show you how we do it. First of all, we don't look at our trading chart at all. We look at the delta of the candles on the two higher multiple Unorenco charts. None of our assessments are done off of our trading chart. Your trading chart provides you with no forward-looking ability. So if you're trading a 2 Unorenco, it's going to look at a 4 and a 6 Unorenco. If you're trading a 6 Unorenco, it's going to look at a 12 and a 36 Unorenco. Now it places the delta value of each of these candles into a 15-period simple moving average. And that smooth moving average allows you to get rid of the outliers. Because the outliers are not going to have an appreciable effect on the slope of this SMA, because it goes back 15 candles to make its assessment. Now, if we make it go back too far, then the slope is going to be too slow. And if we make it too short, then it is going to be affected by those outliers. And via optimization, we determined that the 15 period is just right. Now, when both 15 period SMAs are sloping up, the bulls are firmly in control of the market, and the 3-line V2 indicator order flow line is going to be green. When both 15 period SMAs are sloping down, the bears are firmly in control of the market, and that 3-line V2 order flow line is going to be red. And when the 15 period SMAs are not in agreement, one is up and one is down, that line's going to be yellow. And that's going to be a big warning flag to not trade, because this is when the market is likely to chop, when your two higher time frames are not controlled by the same group of traders. You want both higher time frames controlled either by the bulls or by the bears. Now, here's an example. This is just using the 3-line indicator. And I'm going to show you this on a live chart. And what's important to note here is that this line turns green not because price rises. Price rises because it turns green. The assessment is not being created by any price movement on this chart. It's being created by the two higher time frames. This is what provides this with leading predictive power. And you can see how when price is going to fall into this green. And now I'm not giving you an entry yet, and I'm going to go over the entries later. All I'm giving you is an absolute trading direction. And I'm sure a lot of you have trouble with getting stopped out. And you wonder why. Well, one of the reasons that traders get caught, and let me tell you, the institutional guys set you up for this. These traders in this down candle are trading against the direction of order flow, and they're going to get stopped out. They're trading oscillator divergence. They're trading MACD divergence. They're trading some system that tells them they're going to call a top here. And these are the ones that are going to get eaten up. You have to trade long when the order flow line is green. And when it's red, you have to trade short. If you try to counter trend trade the direction of this line, your likelihood of getting stopped out is extremely high. Here's just another example. Price comes down, order flow turns, the bulls take control, and the market rises. And again, it's really important for me to emphasize, this line turns green because of those two SMAs on the two higher Unirenko timeframes. They're not looking at price on your trading chart. Here's another example. Price, this leads price. It goes green further. I'm going to show you this on a live chart. Price, order flow is going to turn green first, then price is going to rise. If you try to counter trend trade it, you're very likely to get stopped out. When it's yellow, you stand aside. And when it's red, you can only trade short. When it's green, you can only trade long. So what we're defining now is an absolute direction. You have to trade. And remember, what our goal is in trading is to minimize risk. What we want to do is take the lowest risk, potentially highest reward trades. That's what we have to ferret out. And that's how we become profitable. We don't take marginal trades or ones associated with considerable risk. We take trades associated with minimal risk. And that's how we're going to become profitable. Now, here's an example of what happens in CHOP. Now, right now, we just have one line, one of three. But you can see how when this line just continues to change color, price on our trading chart is going to CHOP. And when this swings around to a stable color, price is going to rise. Now, with one color, it's hard to tell what's going to happen. I mean, when you're on the right edge, this green could turn red in any second. So a single line doesn't give you all the information you need. You don't have the specificity yet that you need. So what we did was we added a momentum assessment, which is another force that leads price, and it's equal to that of order flow. Now, there's a lot of different ways to calculate momentum. We used to use Heikin-Ashi momentum, but we use MACD momentum now. I think it's better, and I'll show you why. What we do is, again, we do the same thing as we did on the other assessment. We look at the two higher Unirenko multiple charts. We never make an indicator assessment or an indicator. We never do an indicator analysis based on price off our trading chart. That is not going to get us anywhere. Now, when the MACD line is accelerating away from the signal line, that means we've got positive momentum. When the MACD line is accelerating towards the signal line, that means we have negative momentum. Now, there's also an event when the MACD line crosses the signal line. Now, when I'll show you on a live chart, how that's all plotted out. We make it really simple. But what we do is you look at the slope of the momentum line, and this, I'm sorry, it's not momentum, it's MACD line. Look at the slope of the MACD line on the two higher multiple Unorenko charts. When both MACD lines are accelerating away from the signal line, the momentum assessment's green on the 3-line V2. When both momentum lines are accelerating towards the signal line, it's red. And when they're moving in different directions or not in agreement, you get yellow. Now, we also assess that MACD crossover. And I'm going to have to show you that on a live chart. So let's combine them now. Now we need two red lines because these are equal forces. We need order flow and momentum to be pointing down for us to take a trade. And which simply, you see the halo, and I'm going to talk about the halo later, but this is an up candle on a down 3 line. That's your call to action, because when this pivot rotates down, you're going to go short. And here's an up 3 line on a down candle, and that's your call to action. When price swings up, and it will, you're going to go long. It's an absolute direction that you have to trade. Dual red is always short, and dual green is always long. Here's another example. Now it's getting easier and easier to define chop. When you don't have red red or green green, you can't trade. And when they become red together or green together, you've got an absolute direction to trade. Now, what we're doing really is we're tracking the flow of institutional money, because it's the institutional traders that we want to be on board with. And what we need to do is run over the other small traders like us, because they're always the ones that are taking the trades in the wrong direction. The institutional traders create the direction. We have to be in the trade along with them. So they're going to, the only force that can create a dual momentum alignment on two higher time frames and an alignment of order flow on two higher time frames is the power of institutional money. Otherwise, the markets are going to move in random chop. And here's another example. Now, they can keep you in a trade for a long time. But you know what? The thing that I always say is, I don't care if this trade goes 10 ticks, 25 ticks, or 135 ticks. What's important is that you consistently get low risk, high reward entries, and that when you enter a trade, the likelihood of getting a winner on any individual trade is extraordinarily high, at least 80%. And there, I can tell you with confidence, and I'm going to show you, that's going to be the predictive power of the system. Here's chop, and here's your short trade. And these are traders in the counter trend direction, going long against the direction of order flow and momentum, and their life is going to be short-lived, because the market, unless this line turns, and it's crazy to trade long when it hasn't, is going to roll over and stop them all out. Now, the stochastic is also a little bit of an elegant assessment, because we actually look at stochastic divergence on the higher time frames, even though we don't trade it. But the way we analyze stochastic is this way, and I'll just show you here. We look at the stochastic indicator like everything else on the two higher multiple Unorenko charts. We don't care what's going on our trading chart. If we link the assessment to our trading chart, we ruin the assessment, because it instead of being an independent assessment, i.e. independent of price on our trading chart, it becomes confounded and screwed up by pulling in data from our trading chart. We don't want anything from our trading chart in this assessment. Now, when both stochastic lines are over 80, we don't care whether the stochastic line or the signal line, whether the stochastic line is above or below the signal line. If the stochastic line's over 80, the stochastic assessment is always green. The bulls are firmly in control of the market. When the stochastic line's oversold, less than 20, the bears are firmly in control of the market. We're not looking for the divergence. We're trading what we see. Overbought means the bulls have the market locked up in a bounded indicator, and over and under 20 means the bears have that indicator locked down in a bounded indicator to the downside. Now, when it's between 20 and 80, we look at the relationship between the stochastic line and the signal line. If the stochastic line's above the signal line, it's green. If the stochastic line's below the signal line, it's red. And if they're not in agreement, the line is yellow. And we also do, I just ate lunch, and we also do it, even though it's like getting to dinner time, and we also do an assessment of stochastic divergence, and I'll show you on the live charts how that looks. So now we have 3 lines, and it gets a little tougher to make an assessment. Remember, these are all moving intra-candle, and they're usually pretty stable. But here's what we do to make it even easier. When all 3 lines in place, the assessment can be a little bit confusing. And I'm going to show you some things in terms of stochastic divergence and the MACD crossover of the signal line, so that what we do is we project the results of the analysis directly onto the candles. And you don't even have to look at the 3 line. So what we do is you can change the color and the thickness of the candle halo. When the halo is blue, the 3 line is aligned to the upside. When the candle is, I made it gold, it's aligned to the downside. And you can only take a short trade. So you can start ignoring the actual 3 line and just focus on the candle halo, which calculates intra-candle. You can anticipate it and easily get into a trade. Now you see these gold and black candles. Black is where there's no alignment, or there's oscillator divergence. And in the middle of a trade, it does not matter. We just let the trade go, but we will not enter. Like right here, this is black, will not enter. You have to enter long on a blue halo, enter short on a gold halo. Now, sometimes you're going to get a halo when that first line is yellow. That's because this is only going to turn green. I don't want to make this more complicated than it is. When the MACD line crosses the signal line to the upside. But we assess momentum on the basis of the position of the MACD line accelerating away from the signal line. So we can get positive momentum before the crossover. So the most important thing to do is look at the candle halo. And this will avoid your having to worry about that MACD crossover and stochastic divergence. Now you can do one more, and here's just an example. You can see this is a down 3 line on an up candle. I mean, that is a warning to stay away from this long trade and take the roll to the downside. Here's the same thing. Down candle on an up. I'm sorry, down 3 line on an up candle, it's going to roll. Down 3 line on an up, it's going to roll. That's forward-looking ability. Now, a lot of traders do this. I do it. It's up to you whether you want to do it or not. Since the 3 line data is all projected onto the candles, you can make the 3 line indicator invisible. Now, if you get the software, we're gonna have it visible for you, because a lot of traders want to look at it. They want to see that it's there. But I make mine invisible. I make my workspace as clean as possible. And the only thing that matters to me is the candle halo. So this is all I worry about. I have a blue halo long. I have a blue halo long. I have a gold halo short. I'm always trading in the direction of the multi-time frame assessment of order flow, stochastic, and momentum. And I am rarely, if ever, going to get caught in the wrong direction. Obviously, nothing's infallible, and you're going to take losers, but they're going to be few and far between when I show you the platform itself. Here's another short. Now here's a small long, and here's a short trade, no entry, because the candle halo is black. Here's another long trade, no entry, it's black. But there's your big trade. Your low risk, high reward trades are going to be in the short direction. Now, I haven't defined market structure here, and there are other factors in why you would not take this trade long. And I'm going to show you that in a minute. But these are your two big trades, short and short. Now, how do we get into a trade? And what we do is we use an exponential oscillator. Now, let me show it to you. Now, here you're starting to see market structure, because that 50, and I'll talk to you a little bit about the 50 when we get on the trading chart. Every time the oscillator crosses the 50 line to the upside, it's going to give you this triangle. Now, I'll talk to you a little bit about why this is an exponential assessment and not an arithmetic assessment. And if you want to be a really, really good day trader, you have to understand the difference between an arithmetic and a geometric assessment and movement. Now, there's an oscillator signal long, up, oscillator signal long, up, oscillator signal up, oscillator signal up, always with the blue halo. Now, by convention, by rules, we can only trade the market long above this 50 and short below this 50. I mean, we have to add we have to add market structure and price action, and we don't counter trend trade. We get some great counter trend trades, but I think they're way too dangerous, and our bread and butter trades are all trend trades. So once the market defines itself as being above the 50, we're looking for a pullback to the 50 and long, pull back to the 50 and long, pull back to the 50 and long with an oscillator entry, oscillator signal, and in the direction of the 3 line. And you can see before you get there, the 3 lines turn blue on these 2 down candles. You know that the market's going to turn soon. Here's a blue 3 line on a down candle, and up it goes. Here's a blue halo. Excuse me for 1 second. Okay. Now, here's the same thing. You can oscillator entry, short. 3 line is always giving you the halo. Short, short, short. Below the 50. Now, you can see the counter trend oscillator signals. Here's a long trade, it's successful. Here's a long trade, it's successful. But this fails and this fails. You don't want to counter trend trade. You just want a trend trade. So below the 50, you're looking for a short trade. Above the 50, you're looking for a long trade. It's really that easy. And I wanted to show you exactly how the oscillator signals are created. When this oscillator line crosses the 50 line to the upside, you get an up triangle. When it crosses it to the downside, you get a down triangle. Now, don't worry about these. These are oversold signals. I want to have them removed from the chart, but a lot of traders in the room want to keep them, and I ignore them and we don't trade them. So I don't have any idea what way anyone wants them, but they do. I just don't want you to worry about an up red. You look for down red and up blue. That's it. Here's a down oscillator, cross the 50, get the down. So those are your trades. And what trades you're going to take depends on whether you're above or below the 50. Now let me just explain for 1 second why this has to be an exponential assessment. You know, an exponential assessment is a formula raised to the second power. So it moves a lot faster. Instead of moving in a straight line, it moves like a hyperbola. It slopes up faster and faster. And the reason is that Unorenco price movement is not a straight line. I mean, every 2 ticks on a 2 Unorenco, you're going to get a new candle. It's not like a range chart where every 5 ticks you get a new range, every 5 ticks, every 5 ticks. This moves incredibly quickly and it moves geometrically. So in order to get a great entry, this has to move much faster than a standard oscillator. Standard oscillator will not keep up and give you these kind of entries right on the pivots, almost always. Here in the middle of the move, it has much less power. Right here on a turn, great short. Close to 1 candle over, no problem. Short. Here right on the long, great trade. Now, let me go to the charts. Oops. And let me take this off. And I have a whole million charts up here. But here's the chart I want to show you. Now, I made it, and this is a live chart. We traded it this morning. This is crude. And I'm going to show you these trades. And once I finish, I'm going to, I'll put up any instrument you want. I'm going to put up some stocks. Let me just go till 9 o'clock in the morning. We don't have any trades. Now I want to do a little. I want to explain a little bit more here. Now we take a short. Now let me explain to you these moving averages. I don't want to lose anyone. This is a 50-period moving average. And this is a 15-period moving average. But these are real special moving averages, and I want to tell you what they are. This is a 15, this is a 15 exponential of a 15 exponential. So it's an exponential of an exponential moving average. That's what creates this line. And this is a 50. And this is a 50 exponential of a 50 exponential. So it's not going to trace like any other market does, like any other moving average does. Now you're going to trade short when the 15 is below the 50 and price is below both, and long when the 15 is above the 50 and price is above both. And here is where you start getting your trades, right here. We have a 5-tick first target, that's a winner, and that's a winner. Now that's a winner. That's a gigantic winner. Now remember, we're trading with a lot of specificity. If you want to grab every trade, that's fine. You're going to wind up going bankrupt. If you want to wait for the rules, for the market to come to you, and for price to obey your rules, that's when you're going to get winners. And here's the oscillator. There's the 3 line. The 50 and the 15 are both red. You're trading short, and there's your perfect short. You can't take the continuation trade. Here you can, and you have another winner. Now I want to show you one other thing. Now, if you get 3 or 4 of these entries a day, you're going to make a lot of money. Now, the thing is, you can't trade long here because you need the 15 above the 50 to go long. So there's no long trades here. They're all censored. And you have to wait for the 15 to define its relationship to the 50 before you can trade. And one of the biggest problems that day traders have is they overtrade. And they take trades that are overly risky. And if we want to go back, and we don't have the 3 line here, and we don't have the 3 line here, that's a losing trade, and that's a winner. And we're going to have to give up winners if we want to get the low risk trades. Now, look at this trade. It's a perfect trade. Now, you're going to stay in this trade all the way until the candle reverses. And that's an enormous trade. And what we get traders, I kid you not, who will get 50 or 60 ticks on a trade. That's what you have to wait for. And here's your other one right here. This is in the afternoon. This is not in the middle of this is not in the morning. And there's your other trade right here. It's a perfect trade. Now this, you don't have the 3 line. Here you do, and you just make 5, barely. Here's your next trade. You're not taken out of this trade unless you get a reversal candle. And up you go, right to the pivot. Now I just want to, this is actually, and here's another trade right here. This is such a nice trade. Here and short. Now, are you going to miss some trades? Yes. Are you going to let some winners go by? Yes. But are you going to take risky trades? No. See this trade? No 3 line. Is no trade. Here, unfortunately, you don't have a 3 line, so you can't get this winner. But the trade-off is you don't take this loser. And you're not going to make as much money on this winner, as you will lose on this loser. Now, there's one other rule. Here's another trade. Here and up. Now, I'm going to try to find us a loser, and I'm telling you, it's going to be very, very difficult. And I know there'll be those of you who want to take every single move. There's another winner. Now, let's move to a different instrument. I'll move to the Nasdaq. There's nothing tougher than the Nasdaq, and then I'll quickly show you a stock, and then I'll answer questions. But I want to show you one other thing. As a special, we are giving away this background bias. This background color is the most important independent variable you will ever see in trading. I promise you, you will never see a more important signal. Now, what this tells you is that your instrument, the instrument you're trading, is aligned to the downside on your 2 higher Unorenko time frame charts. Now, you don't want to take a long trade when your 2 higher time frames are aligned in the opposite direction, or one is aligned long and one is aligned short. You want to trade in the direction of the higher term time frames. I think everybody knows that, but it's hard to assess. I mean, if you want to trade 2 or 3 markets and you want to look at 3 time frames on every market, it's very difficult. This does it for you, so that when you've got the 15 below the 50 here and here, and you've got your background pink, these are very low risk, high reward trades. Here, here, and here. Right there, that's enough to take you out for the day, depending upon your target, or your price target. I mean, how much money do you want to make in a day? Well, these 3 trades will do it for you. At 9:50, at 10:02, 10:05, and 10:20. And you see this trade without the 3 line? It goes nowhere. It's a loser. And every trade with the 3 line carries and carries. Now this trade was predictable that it was going to stop because it stopped right at the pivot. It went 7, our first target's 5, but our second target is 20. Now this one hit the pivot again. On a second hit, you predict it's going to break, and it breaks, and this one goes 25. Now I call this trade free and clear. There's no pivot below, and this one goes 9. Every one of these trades is a very, very low risk winner with the 3 line, with your multi-time frame alignment of your trading of crude, and the 15 either right there or crossing the 50. And this is a great line. It is smoother than an EMA, but almost as fast as an EMA. It's like a smooth EMA, and this is like a smooth 50 EMA. I mean, it's a hybrid line, and it's really a spectacular line for trading off of. Now, when you don't have background bias, what I do is, and I've been running this trading room for 5 years. I never trade because you don't have any multi-time frame alignment of crude. And look what happens when there's no background. Price just chops. Look at this mess. Nothing matters. Then when the multi-time frame alignment occurs, you just sweep down. And normally we don't include this background bias, but we are including it. You trade with the 3 line, you trade with the background, you trade with the oscillator entry, you trade short below the 15 and the 50, you trade long above the 15 and the 50, and I'm telling you, your percentage of winners is going to be amazing. And let me go to a different instrument. Now the NQ today gave us incredibly good opportunities to trade, and the NQ is a bear to trade. There are very few rooms that can handle the NQ because it's a monster. It has tremendous volatility, but it also has a huge ability to give us a 30-tick move, and that's what we're looking for. I mean, we're looking for almost 8 points a move. It's really 7.5 points, 30 ticks. Now here's the NQ. Let's go back to the early morning because that's the best time. And I'll show you the whole day. I don't want to wear you out. But we always have an absolute direction to trade. Now here, we've got blue background bias. Now, we can't trade the short. There's just no way to do it. The 15's above the 50. We don't have the background we need, and we have no trade. We had no 3 line here, and we have no trade. So we just have to wait. We have nothing here. We have no trades, no background. I don't care. I always know if you have patience and discipline, your trades will come, and here they are. Here's your first. Now this is a riskier trade because optimally you want the candle to be below the 15, not into it. So that's a trade with a lot of risk. And look what happens. It hits the pivot and bounces. Now this is a much better trade because you have half the candle below it. And there you go. Now these are your first 2 valid trades. Now it comes with a lighter color of pink, meaning the downtrend on the higher Unorenko timeframes is weaker. You'll love the dark pink, but this is still telling you you have a multi-time frame alignment. Now you can take this continuation. You don't absolutely need the oscillator, although it helps. And look at this short trade. The 3 line is blue, and you're right into a pivot, and you've eliminated a loser. That's the most important thing, is you don't get caught taking a trade with the 3 line in the wrong direction. And I'm telling you, it leads price. We can't take a long here, but boom, up goes price. Now, I'm not going to take anything here. This is a winning trade, but I'm not taking it. The 15's above the 50. I don't have background. To me, when I'm on the right edge of the chart, it could blow right up in my face. I'm just going to wait. No 3 line, loser. Not even an issue to take this trade. We don't trade into pivots, and we cannot trade when we don't have the 3 line. And you see what happens? It turns blue on a down candle, explodes up. No background, no trade. And there's your first trade. Now this is really not a perfect trade because you really want it to be above the 15. That's a riskier trade. I don't like that trade so much, to be perfectly honest with you. Now let's keep going. We've gotten some winners. In fact, we've got nice winners, but let's wait. There's a trade, and there's a winner. No background, even though this one worked, I don't care. Not taking it. It's only 10 o'clock in the morning. There's your trade. Oscillator signal, background, 3 line, short. Oscillator signal, background, 3 line, short. Oscillator signal, background, 3 line, short. Now these are full winners. These are 30 ticks. This is a 4 Unirenko, and this is a 4 Unirenko. This is only going to give you a small target. And look at this trade. This is what you wait for. And if you just had the discipline to sit on your hands and let all of that junk you saw before you go, even though there were some big trades, even though the market made a big move, when you're on the right edge, you can't predict if it's going to follow through. And here's the end of your trading day, right here. If you scale it, you're not going to get the absolute bottom, but here you've got 36, 30, and 38 ticks. And depending upon how many contracts and what your profit target is, you know, you made it. Can I say? Now, let me just quickly go. I just simply want to go to the Qs because I just want to show you one stock, and then I'll take any questions you want. I don't want to go on and on and on. I have to disconnect this data feed. Oh, I've got the other one data feed up. Hang on a second. They're both connected, I think. All right, I'm good to go. Let me put up the Qs. I'm just going to put that up as a proxy for stocks because I mean I can show you any stock you want. You're going to get the same signals. Now here's the Qs. Now first of all, we're trading too fast to chart. On this we got to go to a 4, 10, 20. Every single instrument has a different setting, which we will give you. Now here we go. Now, if you traded the Qs, I don't know, you know, remember you're day trading stocks here. There's your winner. There's your winner. There's your winner. Now, actually, this is not a trade because it's into a pivot. We never trade into pivots on a first hit. That's a hard and fast rule that more likely than not, on a first hit of a pivot, it's going to hold. The second and third, the second is 50-50. On the first, most pivots hold. And our pivot indicator does it the right way. Creates pivots off the candle body, not off the wick. And that's a real pivot. Here, you have to brave it, but down it goes and through. Now, there's no 3 line on this long trade. Now, unfortunately, that's a heartbreaker because there's no 3 line. But here's your trade. And down. Here, no 3 line, doesn't go anywhere. Very short, but remember, you're trading right into that pivot. There's your trade. There's your trade. Now, here's why I didn't want to show those other trades. When you're trading into the 15, it's very risky. Here you're trading below the 15. And it's also risky because you're trading into these pivots. It's not a free and clear trade. Now we're going into yesterday. I just want you to see that when the system sets up to give you a trade and you wait for everything to roll in your favor, you have a very, very low risk, high reward trade. You wait for the background bias, wait for the oscillator, wait for this very unique 15 to cross this unique 50, wait for order flow, stochastic, and momentum to be in your favor, optimally wait for an oscillator signal, and you need background bias. You need that multi-time frame alignment of your instrument, and you're going to get close to 80% of your trades as winners. Now, let me show you the offer that we have, and then I'll answer any questions that you have. I'm 2 minutes over an hour, so I'm not going too long. Now, you can trade anything with this. You can trade Forex, stocks, or futures. You can swing trade or you can day trade. If you swing trade stocks, you have to tell us what you want to trade. You have to tell us your time frame, and then we'll give you the Unirenko bar setting. We already have the settings for all the, we know the settings for all the futures, all the Forex markets. And the only thing that's variable is if you, I mean, not many people want to hold Forex or futures overnight, but if you do, we'll give you the settings. But if you want to swing trade stocks, a lot of people want to hold 2 or 3 days. You give us the settings, and we'll give you the appropriate setting. But it's got to be based on what you're trading. If you're trading Amazon, you're not going to get the same Unirenko setting as if you're trading advanced micro devices. So we have to know that. But we will provide you with all that information. So here's the offer. That's the whole system is normally $1,499. This is a lifetime license. The special offer is $599 again for lifetime. It's active on any market in any time frame. And what we do is we give you free upgrades and add-ons for life. And that really means a lot because we're always upgrading the system. We just changed the 50 and the 15 settings. And we had to build these 15 and 50s. You're never going to find an exponential of an exponential or an exponential of an exponential. You're either going to find an SMA or an EMA. We created a hybrid line, and it moves better than both. Way better than both, because we optimize the settings, and you just get those automatically. No matter what we do, that's your add-on. And the first 10 will get that background bias for free. Normally, I don't know what we charge for it, but it's expensive. Now, everybody's going to get a month in the trading room with me. Now, even if you trade stocks or you trade Forex, it's worth coming in because you learn the methodology, you learn the value of the indicator assessment, you learn everything. And it's really going to help you become profitable. And you know what else you learn? Discipline. And you learn to sit on your hands when the market doesn't give you what you want. And the biggest problem, and I think you might know, is over trading. Plus, we have a profit target. When we hit $500, yesterday we had $500 in 7 minutes. We had 2 trades in 7 minutes. We made $480, and I closed the room. I mean, I taught for an hour, but you have to have a goal. If you trade 10 contracts, maybe your goal is going to be $2,000. We only trade 2 contracts or 3 contracts, so our goal is between $400 and $500. You're going to get a 10-module educational training session right off the bat. We have all 10 links, and you get a 450 video tutorial library that's going to tell you absolutely everything you need to know. And the first 10 are going to get the bias indicator for free. Rory, is it rightlinetrading.com/special offer? That's the link. We'll send you an email. But if you're interested, that's the URL. www.rightlinetrading.com/special offer. It expires on Sunday night. Our phone number 786-713-5276. And I'll leave it up. I'll answer any questions that there are. So let me see. Let me answer any questions. Okay. Hold on a minute, Cross. Let me get to you here. Hang on. Okay. Got it. Yes, there will be a recording, Linda. Okay, one item on your website stood out. Can you talk about, okay. They are old, okay? Okay, here's what we did, Cross. The electronic entry system, what we simply did was we changed that to our algorithmic automated system. We just renamed it. And the algorithmic automated system has about 1.5 years worth of data. Now we've taken it off the website, not to hide anything, but because we've taken the automated system offline, because we've added so much new stuff that we need to upgrade it. In other words, this 15 and 50 are new. So they have to be integrated into the automated system. We also have a bunch of other things that we're adding into the algorithmic system. The auto trader is very precise, and it will only take a perfect trade. 3-line, 50, 15. It's really, really tough to get a trade. And when it gets a trade, it's a very, very low risk trade. That's why the data is old, because we rotated it to the automated algorithmic, and renamed it, because it really wasn't, I mean, electronic entry sounded like 18th century. So we just renamed it. That's the reason. Chris, that's a great question. And that is, what determines exit points? And here's what determines exit points. And this is something you're going to see from few other software programs. What we provide you with is an ATM. That's an automated trade management strategy. Now, you always hear traders talk about, I want to get a 2-to-1 risk to reward. I want to get a 3-to-1 risk to reward. You can't get what you want. You can only get what the market will give you. And what it will give you is based on this number, the ATR, which is the average true range. The average true range defines an instrument's volatility. If it's real volatile, like the Nasdaq, you can look for big targets. If it has very low volatility, like the E-mini, you got to set your targets close. Because if you set a 25-tick target on the E-mini, you'll have a beard and you'll be walking around with a cane before you ever hit it. And you're just going to take loser after loser. So what we do is we set up your trade management for you based upon the average true range of the instrument. So let's take the Nasdaq, for example. First target is 20 ticks, second target is 30, third target is 40 ticks. That's if you trade 3 contracts. If you trade 2, one at 20 and one at 30. If you trade 1, you take 1 off at 20. We get 20-point trades on the 20-tick trades on the Nasdaq are easy. Crude is 5, 15, and 20, based upon the average true range of the instrument. So we're going to program that in for you, depending upon what you want to trade. Gold is exactly the same, 5, 15, and 20. The Dow is just like the Nasdaq, 20, 30, 40. Depending upon your Forex pair, we'll give you an automated trade management strategy. So once the trade hits and you're in the trade, it just evolves on its own. You don't touch it. You're going to be in with a trailing stop. Every time the trade moves up a tick, your stop gets pulled up a tick. So if you miss your first target by 1 tick and it comes back and takes you out, you only take a partial loser. You know, Brandy, this is going to work on cryptos. I've never traded them, simply because these platforms are not as sophisticated. Like you can't get order flow on. I'm a member of that really good chart. I want to say it's Coinigy. That's probably the most advanced, but you can't get these kind of signals on the crypto market. But listen, if you could, it would obey the same thing. It's going to look at the number of buyers and sellers on the dome. It's going to look at momentum, and it's going to look at order flow. We just can't do a multi-time frame assessment on any cryptocurrency chart because right now they're sort of primitive. That's the only thing. And I want to be honest with you. I don't want to tell you you can trade it when you simply can't get this kind of, no problem, Chris. When you can't get this kind of analysis off of it. That's why I would be a little careful with crypto. And, you know, I own a few, and thank God I don't own more than I do. But I just don't like the trading platforms for it. Now, listen, if they create a platform sophisticated enough to handle the analysis, we'll do it because it would be unique in the industry. There just isn't one yet that's available to do it on. Coinigy does not have this kind of data. So we just can't do it off of that. So that's the only thing. I mean, if you want a day trade or swing trade, I would not do it with cryptos. The volume's too thin. Small traders can blow the market in either direction. I mean, I think you're better off with Forex, stocks, or futures by far. I mean, you've got good volume. The NQ volume is awesome. E-mini volume is great. You know, day trading the Qs, the risk to reward on the Qs, you can get 5 to 1, 6 to 1, 7 to 1, because this is not leveraged. Forex and futures are leveraged instruments and stocks are not. So, I mean, on 10 cents of risk, you can look for 70 or 80 cents of profit. So you get one loser and one winner, and you're up a ton. And I'm telling you, 80% of these trades are going to be profitable. So listen, that's it. I don't want to hold you up anymore. And I really, really thank you for your time. And one thing, if you come aboard in our family, one thing I'll never do is mislead you or tell you anything that's not true. I'm not the guy who says, you know, I woke up one night, you know, I was laying in the gutter and I was destitute. And all of a sudden I found these 3 market patterns. And now I made my first 25 million and now I'm going to sell it to you. You have to have a lot of discipline. You have to have, and it takes a little bit of work, but these are real good signals. And if you really just have the discipline to wait and hit when it's right, you're going to get a lot of winners and you're going to make money. So thank you so much for your time. You can call us at 786-713-5276. Rory's here for a while and he'll answer any questions you have. And we can have you in the trading room tomorrow morning. Hold on, Brandy, let me answer. Let me tell you, Brandy, everybody in the training room tells me how unique this system is. There is nothing like this anywhere. And I really mean that. If you try to find a system like this, you will not. Because this is based on mathematical modeling. And I'll just tell you something really, really quick. I never diss other software, people who sell software, because I don't think it's professional. But the one thing that I do is I ask the people who are selling software, what is the sensitivity and specificity and positive predictive value of a trading entry? i.e., to put it another way, sensitivity over specificity times prevalence equals positive predictive value. And let me since you're here, I'll just give you a 60-second sensitivity over specificity times and if you know this, I'm telling you, it's going to help you so much with your trading, equals positive predictive value, or win percentage. If I could type, it would be help. So when are you most likely to get a winner? Well, it's going to happen in a market that's trending. How do you define a trend? You define a multi-time frame alignment with the background color. That's going to tell you when the likelihood of long trade occurring is high. So the PPV, or positive predictive value, is really very much dependent on prevalence. When you trade with a lot of sensitivity, you go for everything. You try to get every winner. When you trade with a lot of specificity, you try to avoid every loser. That's what we do. Our system is gamed so that you're going to avoid the losers and grab the low risk trades in an area where the prevalence of a winner is high. If somebody's selling you software cannot define that for you, what area that is for you, then they know nothing about what they're selling. So that's really it. I mean, it's all based on math, including your entry to first, second, third target, and your stop. It's all generated not by what we want, but what the market is likely to do based on six months of market replay data. So listen, everyone, thank you so much. No matter what you do, I wish you the best of luck. I mean, we're the small guys. We got to take the money from the other small guys, but I wish you the best, and I really hope you're profitable. If you come aboard, I'm very, very available. I'm around all day. I'll be more than happy to help you with your questions. And Sergio does the whole installation. You don't have to do anything. He'll install the entire system for you. Do not worry about any tech stuff. I'm a tech idiot savant. I can't do anything. And I rely on him for everything, and he'll do everything for you. No problem, Brandy. Take care, everyone. Have a great, great afternoon. Bye-bye.